While the current economic landscape appears serene, I cannot shake off an unsettling feeling rooted in the prolonged absence of a recession. Signs of heightened investor optimism and an influx of new participants in the market serve as uneasy indicators. History, with its cyclical nature, whispers a foreboding tale, suggesting a potential economic downturn looms on the horizon. My unease extends globally, envisioning a recession before the year's end. The genesis of this ominous prediction lies in the trajectory of the U.S. economy and its counterparts in developed nations, all seemingly heading towards a precipice. The forthcoming elections add an element of speculation, contemplating the Federal Reserve's potential resort to rate cuts and money printing, a move fraught with the risk of exacerbating inflation. A disconcerting factor amplifying my concerns is the staggering increase in global debt since the 2008 recession. The ominous prediction takes shape with the belief that the next recession will surpass the severity of the 2008 crisis, an era etched in economic history with scars still visible. Even China, once a pillar of support during the 2008 crisis, now grapples with substantial debt, casting a shadow over the stability of the global economy. History teaches us that economic downturns often find their origins in seemingly inconspicuous places. Reflecting on the 2007 Icelandic bankruptcy preceding the 2008 financial crisis serves as a stark reminder. Minor issues, initially overlooked, can snowball into major problems with alarming rapidity, unleashing economic turmoil. My skepticism extends to central bankers, whom I perceive as bureaucrats and academics ill-equipped to effectively manage inflation. The current correction in inflation, coupled with the potential for interest rate cuts, raises concerns about market declines. The historical precedent of markets reacting negatively to central bank rate cuts looms large, exacerbated by the widespread money printing by central banks globally, a practice likely to escalate if trouble arises. The strength of the US dollar provides a deceptive calm amidst the storm. While acknowledging its current robust position, my readiness to exit this position at the first sign of trouble underscores the lurking fears. The colossal US debt pile, a proverbial elephant in the room, leaves me apprehensive about the dollar's long-term status as a foreign reserve currency. In response to these apprehensions, I find solace in the enduring ownership of precious metals, gold and silver. These timeless hedges against economic troubles offer a semblance of security. Optimism particularly surrounds silver, viewed as undervalued compared to its historical high. The potential for silver as a commodity investment becomes a focal point, with contemplations of increasing holdings if the right opportunity presents itself. Silver's current state, down nearly 60% from its all-time high, suggests it may not be in a bubble, rendering it a more attractive investment option. This positive outlook on precious metals stands as a bastion amid the swirling uncertainties of the economic landscape. The attribution of inflation to every money-printing campaign by central banks intensifies my concerns. The repercussions of extensive money printing echo in my apprehensions about the natural consequences this practice entails. Real assets, such as gold and silver, emerge as beacons of stability, expected to weather the storms of inflation and economic challenges. Amidst these apprehensions, a recurring prediction echoes, the anticipation of the worst crash in our lifetimes. The signs, once distant, now seem to draw nearer, pointing to an impending historic event. The ominous undertone persists as I reiterate the belief that the next bear market will likely be the worst, fueled by the astronomical increase in global debt since the cataclysmic events of 2008. As I cast my gaze on the global economic outlook for 2024, wariness envelopes me. The official narrative, painting a picture of achieving a soft landing in 2024, leaves me skeptical. The anticipated recession becomes a looming reality, prompting expectations of the Federal Reserve resorting to familiar tools, rate cuts and more money printing. The intertwined factors of a recession and upcoming elections create a volatile cocktail, contributing to the looming specter of inflation. In conclusion, the economic landscape, while appearing placid on the surface, conceals a turbulent undercurrent. The extended period without a recession sparks concerns, and historical patterns, coupled with global debt levels, intensify these fears. The predictions of a global recession, the worst crash in our lifetimes, and the role of precious metals as safe havens become narratives intertwined with skepticism about central bankers and the prevailing economic orthodoxy. As we navigate the uncertainties of 2024, the unease lingers, a testament to the delicate balance between economic stability and the impending storm. Please go ahead liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.